I'll start. Good morning, everybody.
Good morning.
Yeah, so I was curious how many people are in attendance. So if Mark, if you could not, I think we had like 30 at the last, but including a few people from online.
Right, yeah, and more will wander in.
Yeah, yeah. So Chris and I are going to go through a few things. I'm going to start by going through the year-to-date, 6 months, first half expenses versus income and versus budget. There's a handout there if you don't have one somewhere on a table in there. I encourage you to get one. I'm going to go off on my video here just because I have low bandwidth and I don't want to, it's already cut me off before the meeting once, so I'm going to do that. So Nick, you can advance the slide.
Sure.
So what I do is talk a little bit first about income on page 1 of the handout. At the top is the income. I was happy to see that envelope giving is up over 2025, 5%. I think I know last time I showed you the hockey stick, and you've probably heard it too many times that over I think it's an 8 or 9 year period, it's shockingly consistent that 35% of our income comes in Q4, and heavily in December. So the document you're looking at is a straight line. The way our bookkeeper does it, divides by, this would be, divided by half the budget numbers. And if we adjust it for seasonality, we're very close to budget, about 3% below. Below that is all the other income items, and those are 15% below the budget. However, driving that is the income from the capital improvement fund, which technically in general accounting principles would be a balance sheet item, but for clarity, we include some balance sheet items on this budget that you approved. And if we don't consider that, the rest of the income is at budget. One of the new things this year is our tenants, if we should call them that, people using our facilities are sharing expenses, mostly utilities, but also supplies. And I'm happy to say that those are all coming in regularly and actually a little over budget, under budget on that. I'm sorry, more money's coming in than we had budgeted and thought would come in. So, but that's entirely, driven from probably lower expenses on some of the utilities. Parking lot income is, you'll see on there, I think it's 70,000, and that is finished. So that number will stay the same for the balance of the year. I think I'm right on that, Chris. We're done with the parking lot.
Yes.
Yep. Okay.
That's a leak.
Yeah. And I neglected to say that, this is 4 pages of numbers and there's a lot of things in there. If you want to study it, in detail and send Chris or I questions, offline, please do that. And then Nick, if you'll advance it to the next slide. So on the expenses, we are over budget on expenses, a couple points. Just like is same in Q1 when we reported on this. What's driving that is the HVAC and plumbing repairs that we had. Really, I think most of those were in the first quarter, and they're still driving, a budget excess. But we also in Q2 though made a tax prepayment of $100,000, and you'll see that on there. and our budget was 90, but it was decided to pay 100,000. And we also paid off the Mission Investment Fund letter of credit, which we had not budgeted for. So that would drive these three things were the big drivers in being over budget on expenses. You would think we'd be way over, but we're not because we had some things under budget. The utilities were significantly under budget, although we always know that that's probably going to normalize, through the summer months and the higher electricity bills that we would expect to see. Of course, we don't have this expense of the associate pastor that we budgeted for. And a good part of the first half, we did not have the property manager in place, which we do now, thank God. So also, go ahead.
We're all thanking God for mindful.
Amen. I haven't met him yet. My wife met him not long ago. So, and then we also haven't incurred expenses to the extent that would be budgeted, half of the 200,000. And we did not, there was some expenses in the capital improvement expense fund, but it was significantly under budget. And then if you'll advance it one more time, Nick. So you'll see at page 4 at the bottom that income less expenses we're to the negative $150,000. If we would take out the letter of credit payoff, that would be about a $60,000 deficit versus budget. Although, I would say that it's my opinion that we finished, 2026 pretty much near budget, but, some things have to happen. I'm real certain that Q4 giving, will be like it has the last 9 years. And, we don't know if there's going to be more, maintenance, plumbing, HVAC repairs, and hopefully not, that we've seen the worst of that, and that we will not incur any more tax liability than we've already accounted for. So, I wouldn't anticipate that's still outstanding, and Chris is going to talk to that. But all in all, I think we're in a solid position. So I don't know, Chris, if you have any comments about what I've spoken about before you head into the next slide.
Yeah, just one important comment. You've highlighted it here, but recognize, please, that the line of credit payoff was not really, it shows as a negative. It wasn't a budgeted expense that we've exceeded some sort of predetermined expense. That was determined to be a way to utilize our Parsonage Reserve Fund account. Most of you will recall that was agreed on in the first half of the year. So there's been a certain amount of money that's been redeployed from the Parsonage Reserve Funds into clearing debt and other items that I'll cover later. But for purposes of presentation in the financials, at least at 6 months through the year, it was shown as a quote negative, as an expense. It comes through as a use of cash. So when Eldon says we really are running about a $60,000 deficit, I think that's more accurate to think about that 60 instead of 150, because the extra 92,000 was cash we had in the bank, and it was offset against a liability that we had for the line of credit. So that was not a new expense so much as a balance sheet item.
Right. Thank you. So that's what I had. Like I said, any questions that you might have that you think of later, or after you look at the document, just send it to me and Chris, and we'll.
Chris, what was the logic behind the tax prepayment and the increase of the tax prepayment? Can you talk to that?
Yeah, it was just the computation was 92 or 93, something like that. And we knew that we were going to most likely be paying more than 50, less than 90, but we would need to go ahead and make some sort of payment for the 2026 taxes as well. And so the extension payment for 2025 will become an overpayment that will just apply to 2026. So that number was just, frankly, it was just rounded to 100 just to present a number to the accountants for the extension.
Thank you.
Yeah. It wasn't some sort of newly determined bigger tax bill. I still believe it'll be a lower tax bill, but
Yeah, I do too. That's why I asked the question.
Yeah,
So
yeah.
presentation.
That's covering the second year, because as we've talked about before, ideally we should be paying, we are, and we will be in the future paying installments. So you're paying your 26 taxes as the year goes along. You get to the end of the year, you've made all your payments, and you file a return that reconciles those balances with what you actually owe. And when we discussed this last fall, we really did we had the conversation in the context of the 2025 taxes. And until we complete that computation, we don't really know what the 26 tax, the 26 is being based on 25, but we don't believe that 25 is going to be 100,000. So this is kind of a guess for now. By the end of third quarter, we will have all the answers to this question.
Yeah, and isn't it true that we're still learning and implementing systems to do appropriate expense allocations?
Yes,
And
that is
that's
correct. Yeah, that's a big part, and I'll cover that later, but that's a big part of the conversation that's going on with the accountants, is to kind of investigate that, think about ways we can maximize our deductions, our arguments for deductions to lower that tax bill.
Thank you.
Appropriately lower it, not, exactly.
Could you please explain again briefly the income that's taxable?
Yeah, well, there's still a debate. I won't say it's a huge debate, but there's still a conversation going on with the accounting advisors that should be completed during August to kind of conclude on which income we are receiving that we're going to determine to be taxable. And it's important, as you understand, it's important to make that determination in that initial year, because once we start claiming certain things are taxable, it becomes very difficult to change that position later. It's possible, but it becomes challenging because you've already taken the position one way or the other. So in the short run, right, we have rents for the big item is rents for crossing borders. Okay. In the past, there's been an argument that's been made, and I'll say relied on in the past, that the business of crossing borders was an extension of our mission. And just using that loose argument, no taxes have been paid on our revenue, less any expenses, but that hasn't been determined. It's been decided that the crossing borders revenue stream is not taxable because it is tax exempt, in line with our mission, with our non-taxable purpose, right? That has become less sure as we've started to expand the amount of money they've paid us, the types of customers they have, the use of our facilities, and the scope of what they're doing is just becoming bigger and bigger, and it's a larger and larger portion of our budget. And there's not necessarily a hard and fast rule to that, but just as it gets bigger, the exposure to getting it wrong or having it decided to be wrong, losing that argument becomes more. And so we're looking at that to try and marshal the appropriate legal reasons why it is or isn't taxable. And on the premise that it's likely taxable or partially taxable, we're also trying to maximize the argument, come up with arguments to maximize the deductions that would be associated with that business. So, for example, a lot of the classroom space from the Crossing Borders activity is in the Chaucer building, just, some of their activities in the Chaucer building. We maintain the Chaucer building with a mortgage. We have a payment that we make to have purchased that property, and we have certain payments that we make on debt that was to rebuild that facility into the condition it's in now. So the interest on those notes is arguably deductible against that income, at least partially, if not a lot, right? We've set up mechanisms to track expenses that we incur that are being split between the parties. So, utilities and other things, but also simpler things like cleaning and things that aren't necessarily, we might not necessarily be billing them for these items or sharing an expense with them in exchange for a check, but we're incurring those costs to run that business. If it's going to be a taxable business, we have appropriate business expenses that we're trying to identify. Another line of taxable income, at least in the last 2 years, has been the rent on the parking lot. That's almost certainly taxable income. That's a challenge to come up with an argument that that's somehow in our business model for nonprofit. And so we're trying to maximize the cost that can be appropriately associated with our rent of that space to the construction firm. Those are the two larger items that concern us as we're going through and filing these things. There could be a couple others that I'm not thinking of, but those are the big items.
We are working with an accounting firm that specializes in nonprofits and
Right.
has portfolio of other churches and churches that have other sources of income as their clients. So we're not as non-experts trying to wing it. We have experts who we are paying as our outsourced professional advisors to assist with this analysis.
Yeah, exactly. And the tax return forms that would be due for the church, assuming we come to the conclusion that we have taxable income, which I believe we will decide there is at least some taxable income, those returns would have been due May 15th. We filed an extension appropriately at that time. We have paid, say again?
March 15th.
Yeah, we have paid that extension. We filed that extension, and the final due date is in, I think it's November now. Those returns have changed a little bit. I think the due date this year was May 15th and November 15th. But as Alicia said, the firm that's working with us is tracking those things. I have phone calls with them. I've had a couple phone calls with them already. I have one next week with them to continue pressing. And I believe we're going to have the final answers to the question of what is or isn't taxable here in the first 3 quarters of August, but certainly by the end of August, and then have the returns filed in September.
Nikki could probably advance this slide.
All right. So, yeah. So I've touched on the taxes. I don't have necessarily anything else to add to that, but if somebody has another question, I'm happy to answer it. One of the other items that we did mention in our last forum that we wanted to cover was just sort of the current situation of debt, where we sit with our Mission Investment Fund debt. This is things that are visible in the financial statements each month. If you get yourself a copy of right, quarterly at least, but if you get a copy of the reports that are sent through to council, you see these running balances, but you don't necessarily see all of this information. So we currently have 3 major loans outstanding. If you don't include the loan to ourselves, which I'm going to cover separately in a minute, we have 3 loans that we owe money on, right? We have 3 debts currently: the Chaucer property purchase debt, the Chaucer property construction loan, and the line of credit, which was effectively paid off 4 months ago. This number was about $90,000. Now it's $1,000. We've decided to leave a small balance in the line of credit under $1,000 so that it can be maintained and still sit there if we need to get to it. It doesn't close automatically unless it has a 0 balance. So that line of credit is potentially $150,000 we could draw against. And right now we have a $1,000 balance. It's interest only, so we technically don't have a payment to make each month if we choose not to. You can see the balances on the other two loans there and the current rates that they're paying, that we have to pay, and the payments. Those are monthly payments as they sit now for those loans. I didn't put on here, and I couldn't find it quickly, like the remaining life on these loans, but you could kind of run the math there and see what it would be. These payments are monthly. The construction loan is to be paid off much sooner, obviously, than the acquisition loan for the property. And the only other thing that could happen is these interest rates are eventually subject to readjustment. The construction loan and the line of credit are going to be readjusted this year, and the longer property note, I think it doesn't readjust until next year, which is why it's still lower. It's still only a 4% loan, 4% note. But if these adjusted to the Mission Investment Fund rates that are sort of out there now, they're going to be 7, 8, 9% with current conditions. So that's the debt load that we have now. At year end, there was an additional $90,000 in line of credit, and there was an additional $250,000 loan that existed related to the parsonage purchase. Once we sold the new parsonage, the newly acquired parsonage, and cleared that out of our portfolio, the proceeds from that sale were used to pay off the temporary note to purchase that property, and that balance went from about $250,000 to zero. So this is the entire portfolio of debt that we have in the financials now.
Next
Okay.
slide, Nick.
Yep. If you'll, one more slide, please. So I mentioned before, and those that have been following closely will know, we had something on the magnitude of $700,000, I think, of cash that after we paid off the parsonage notes and we sort of got everything finished, there was an excess fund of about $700,000. That money is banked and accounted for as a separate fund to be decided what to do with later. But for now, it is locked away, and I'm calling it the parsonage fund. Okay, it's proceeds from the parsonage. It's the amount of cash that remains after we've done purchase and sale of various parsonages over the years. And there's been suggestions ranging from hold it to buy a new parsonage all the way to use that money to help fund a new parson's, a new pastor's purchase of a home, to use that money to raise the salaries of the pastors in the future, to allow them to buy their own homes, to use that money for other purposes, like our capital campaign. And that has not yet been determined, but for now it has been determined that it will be held to the side, waiting for that answer to be decided. Okay. And so that money's put to the side, but 227,000 of it has been used. And that was the determined amount at the last decision point for this fund. These were the three items and the payoff of the line of credit that it was decided funds would be drawn from that, money would be drawn from that fund for these purposes. You can see them listed here. This was decided back in first part of second quarter, I think, something like that. 227,000 has been used. We are scheduled to pay that money back to ourselves with interest into that parsonage fund, currently over a 7-year window. It could be made shorter. It could be made longer. It could adjust if it's appropriate for interest rates to adjust, but that's just how I've sort of computed it for now. Andrea and I have taken a look at this, and this is sort of like the lifespan of some of these items. It sort of makes some sense. That's what we wanted to just start to account for. So if you'll flip the next slide, please.
Oh, what is AHU and lift pump? What are those things?
Yeah, the lift pump. These were plumbing items on the Rice campus. The lift pump was, as I understand it, was something in upstairs to lift either sewage or water supply to the upper floors. It seems weird that you would pump sewage upstream, but it might have had something to do with sewage. I'm not sure. AHU, this was, I think something to do, it was also something to do with plumbing.
No, it's air conditioning, Chris. It's air handling unit.
Air handling unit. I'm sorry. Yeah, that's right. Yeah. So this is the devices that move the chilled air through the building. It's fans and duct work and other things that were required in the attic, in the upper floors. This was all back in the spring. Okay. So that $227,000 is being thought of, at least for now, as a loan by the congregation, or that's not right, by the fund, by the parsonage fund, to the congregational operating fund. The congregational operating fund is then going to pay this back with interest. We decided that the appropriate rate to use would be a comparable rate that much money could draw through the Mission Investment Fund savings system. And currently, for something in the 2 to 7 year window of time, we would be paying or receiving, depending on how you look at it, 4%. So that's just the computation that's been used here for purposes of just sort of initially tracking this. That works out to approximately, and if you pay that $227,000 back over 7 years, that works out to approximately $3,100 a month. So what's happening is during second quarter, you'll start to see these numbers hit. There'll be about $3,100 per month moving out of operations as an expense item to repay the the parsonage fund. Still haven't decided ultimately what to do with the entire amounts that are in the parsonage fund, but as the year goes by, as the next few years go by, over whatever period of time we decide is appropriate, currently 7 year window, that will be repaid. Okay. And what we're going to do is each quarter, we can present an update on the ins and outflows of this relationship, what's happened, what's actually been paid, and how it's affecting budget and so on. Okay. So we're committed to making that fully transparent. Any other items that need to be drawn on that account that would be added to that list we looked at on the previous slide? None are currently approved. So I'm not to spend that money on any other thing unless it's decided. If council decides that's what they want to do, then we can, but that's not anticipated currently. Okay. Any questions on that?
I thought we had sold the parsonage. Why is there a loan?
So it's in a fund, and we basically loaned ourselves the money to make repairs, and so we're paying ourselves back. Using the source of the funds from the sale.
Yeah.
Okay.
We're kind of
Yeah, Tony,
separate.
this is a loan by the parsonage fund to the church. Think of it that way, right? Yeah. To the operations of the church. So I'm calling it a parsonage fund loan. Yeah.
They aren't just draining the fund, but they're draining the fund and they're gonna pay it back.
Correct.
Big-
Correct. That's the plan. So I didn't necessarily have any other topics. I know we had talked about just generally this being a quarterly update session. I appreciate everybody being, we calendared it and so on. I'm currently in Seattle, Washington. I'm a couple hours behind you guys, I guess, ahead of you and behind you. And Anita and I have been out here for the last month and a half working on kind of closing up some things with her mom and moving some stuff out. But the other day was my birthday, and a couple days ago, and I got a phone call from my younger son, Peter, from the top of a 14,000 foot mountain in Colorado, where he was able to, he had gone up with some friends before sunrise, and he called me at like 7 a.m. my time to say happy birthday. And I thought, well, that's tough to beat that. And then later in the day, Zachary called me and announced that he was engaged. Engaged to be married. So that was big news for us.
Congratulations.
Yay.
Yeah, exactly. So we'll see how this how it unfolds, but it's exciting times for us. I plan to be back in Houston by the second week in August at the latest. And what I'd like to do is go ahead and think about our third quarter presentation for this forum to be sometime in October, probably mid-October, so that it falls right around the time we are getting into the budgeting process. And so if anybody has topics they'd like to hear about or something more clarifying, let us know. We'll make a point to put those on the schedule. But I'm already planning to make that time period a big part of the push for the capital campaign. You know, Eldon alluded to the fact that our giving is down if you include the capital campaign requests, but basically flat or just a small amount down for everything else. And you'll recall that the budget assumed certain gifts for capital purposes, and then we were going to adjust spending if they weren't forthcoming. And we have been able to adjust some of the spending, the emergency spending that was needed to be done. We had to borrow from the parsonage fund, right? The capital donations have not met the targets yet. And so we're going to make sure we explain that to everybody a little bit better and more clearly. But I encourage you to think about that. And if you do have specific gifts or things that you'd like to put into the capital fund, we have those segregated as well and have a good way to track that. And people should feel confident that those monies are going to be parked to the side for capital purposes and not just be absorbed into the general operations. But we can clarify all of that with more detail. So I think those were the prepared comments. Eldon, you said that there could be something else that maybe another member of the finance committee.
I didn't know if Ron was in the house. He's been very, very active in the cleaning up of designated funds. And I don't know, Ron, you have anything to add on that? I think we're paid up on the mission funds.
Yeah, let me add a couple things. First, before I talk about the designated fund, let me say, as a member of the finance committee, I have 3 requests of the congregation. First is obviously maintain your giving. You know, that is so important. Second of all is pledge. You know, last year we did not get pledging, as you know, many pledges. A lot of people continue to give without pledging. As we're going in and going to be creating a budget for 2027, it is absolutely helpful and important that we receive pledges so we know what we're dealing with. You know, the budget for 2026 was frankly done based on past experience and hope. You know, I would like to see 2027 be based more upon actual pledges. The pledging, the stewardship program will kick off in September. Please pledge. Third thing is, if at all possible, make your giving automatic. You know, use online giving. You know, as Eldon points out, our giving has this hockey stick effect where we make up, you know, a lot of it on the third quarter.
That's always true.
Our budget doesn't do that. Our budget is flat. The closer we can come to matching our budget on a monthly basis to income that comes in on a monthly basis, it makes life for the finance committee and everybody a whole lot easier. We don't have to do these transfers of money. We don't have to activate lines of credit, et cetera, et cetera. So those are the 3 requests. Give, pledge, do it automatically. Okay, any question about that?
Who would contact to do that?
Well, you can go online through Titleist.
Isn't that QR code in the back?
You know, the
Yeah.
QR code will.
Give you a pledge.
I give a pledge, and I'm really saying activate that next year. You know, we will have a pledge program,
Okay.
a stewardship program that I believe is starting in September. Absolutely, please pledge. That is really helpful. Now,
And that's okay if our monthly giving is reflected in the pledge, it's the,
or, yes, your monthly thing, it should reflect that pledge. You know, if by chance you want to make a pledge and give it all in January. That would be nice. But
Don't wait till December.
but just don't wait till December and make up for what you missed.
You know, but I mean, there are people who are commissioned, right, and they
Right.
have a
And
huge.
and if you have a little bit extra in December, we're glad to have that.
yeah,
too.
that's
So-
not an unreasonable.
Well, in terms of the designated funds, we have a fair amount of money, a couple $100,000 frankly, in what's not identified as designated funds. These funds are included in our total bank accounts. These funds, some of them result from donations that were given for activities in the past. Some of that are no longer appropriate. Some of these were transferred over from Memorial Drive. And for specific activities that had been designated Memorial Drive, which are no longer something we have planned as part of our mission. So what we are looking at, and Lucky has been very involved in this, is identifying what's the appropriate use for these funds. We clearly cannot go back and find out who gave this money and say, no, we aren't doing this, so here's your money back. We can't do that. They have given the money to this church. And we are trying to figure out how closely to match that desire to what's an active need at this church. Okay, so we're hoping to get this wrapped up in the next month, get something to council and identify those funds. There, up until this last year, we had listed those funds, and this is an accounting point that may not be of interest to people, but we had listed those funds as liabilities. Also, we had listed mission offerings, money that is given, to our mission offerings, where we stand out in the narthex each month. We had also listed those as designated funds. And all of those funds, both the internal and those mission partner funds, were counted as liabilities, designated fund liabilities. It does not make sense to list the internal funds as liabilities. Those are things that we don't owe anybody else. They're money that we have that we can determine.
But
how
it's
to use.
money that we don't have an assigned spending.
We do not have it in the operating fund,
Yeah, some are assigned, but we
Some
don't
are
have that
assigned.
expense right now.
but
Yeah,
it's no longer, the thing they were signed for is no longer appropriate or no longer needed. So, we're trying to do is figure out
how to manage.
how to manage those funds, and those funds range from a fund for a library card to a fund for, replacement of server rolls, to a fund for, travel. Some of these are very active, some of them are not. We're trying to get our arms around all of those, simplify the process and so forth.
Are they created by dedicated fund?
Yes, yes. They're
So
created by, I guess, many of those were created in the
that would
past.
be a good way to find out how some other churches are handling.
Yeah, I think we've got a good grasp on that. The other thing, there was some monies outstanding that, were designated as mission offerings, approximately $30-some thousand that was sitting there. And we have since gone in, with the work of Cheryl and Andrea, our accountant, to identify the appropriate person who gets those funds, appropriate organization. And we got those funds to those organizations in June. The goal is that those monies should flow in and out quickly. They're given for those purposes of those outside organizations. And it is not appropriate for us to be holding on to those for any
I think
period of time.
it's appropriate, Ron, to say that also last year, or perhaps the end of the previous year, we adopted a gift acceptance policy. to regularize and normalize the process when somebody comes and says, I want to give $10,000 for, or I want to give $750 for. There is now a process for what happens with that. So this is a backward-looking, problem-solving
Who's
exercise.
responsible for spending that money?
That there's a whole policy that says if it's a cash gift, this happens. If it's an in-kind gift, this happens. We're happy to make available the gift acceptance policy. It was made public. It was adopted by council. The finance committee has it, and so there is a process. This is what Ron and Lucky and I, with respect to the Memorial Drive campus, are doing is looking at 30 years backwards of not having had or not having followed a consistent and understandable process. So this is cleanup, and, you know, thanks be God that we have, who's on the finance committee in here? Our finance committee has grown. Look at all these people on the finance committee. And be really nice today, because they're gonna help with the budget, they're gonna help with having these quarterly meetings. There is a lot of work that was just not able to be done, because we had a couple of people, Eldon and Chris, right, who were doing so much for so long on their own. So thank you to all of you on the finance committee for taking us into the future, and also at the same time helping us clean up some of the past. We're really grateful for your work.
I have one other question before, if I may. Looking at the tax, for service and care here, there are two lines in the budget, and they're identical. Property taxes and income taxes. Is that are those, when I get these kinds of things, it looks like somebody just copied that line and set it in the down below. So it's on page 4.
No, that's in, let me answer that question, and we can clarify this when the income tax return is also completed and the property taxes for the year are determined. But the answer to your question is that's intentional. There is a thought that we could also, in addition to income tax, right? We're a nonprofit religious institution, but we might have some activity that is considered unrelated business activity and becomes income taxable.
Yeah.
If that is the case, there is a possibility that the state will not fully exempt our property.
Chris, that's not the question. The question is that line 660-100 and 660-101 are just identical.
No, they're not.
No, they're not. See, the total is identical.
Property taxes.
And property tax is 0. Okay. Oh, it's
That-
total.
My bad, sorry.
Chris.
Right.
But
Yep.
just another question, I'm a curiosity, do we have anybody who specifically does our taxes?
Yeah, we have
Yeah.
an outsourced law firm. that's
Yeah, we've
special.
reached, we had a few people, in the past, we hadn't had any income tax liability. We had payroll tax and certain other things. For my entire career, my day job has been income tax, accounting and so on, but not in this particular area. It was determined more appropriate to not necessarily use somebody internal to the committee or, an internal person to start filing the taxes of the church when
No,
the
that
numbers
sound-
became more than just a few $100s. So we have engaged an outside firm that's helping us with the income tax and property tax analysis. And Martina signed that agreement with them earlier this summer, and they're working with me and the accountants on those filings.
Chris, was it confirmed that they were helping with the property taxes as well, or was it just income taxes?
Well, it's ideally both, but as you heard, is that Anna?
Yeah.
Yeah, as you and I talked about on our last call, earlier this last month, I guess, the income tax firm is not really the property tax team.
Yeah.
And so finding, the answer to that is not as easy as let's use the same exact company, but they're helping kind of think that through with me.
Lucky might have somebody.
Yeah, I also will, so we can be
Yeah.
next.
Chris,
Yeah.
if I could jump in here, please. Ron has said that we're no longer carrying the designated funds as liabilities. Where are they reported?
I'm not sure that's been corrected or been changed in the financials yet. Ron is, I think, just talking in generalities, like they were treated as liabilities in the past.
I could
Eldon, you might have to speak to that. Like, where do they appear in the financials currently?
They appear as assets.
Yes, so the
The
problem.
money appears as assets, but the offsetting credit has to appear somewhere.
So
Typically, it is an equity item.
Would you let Anna speak, please?
I could try to say, so it is considered an asset because it is cash, but it is a restricted asset. It's not the typical thing. So we wouldn't just pull from that money on
Anna.
daily basis, yeah.
We have cash
Yes,
and there has to be an offsetting credit.
yes.
And where is that credit? That credit is all designated funds typically reported just as a total, and there's a subschedule.
Well,
Where is it reported on the balance sheet?
it's, so there's always gonna be cash, cause it is a physical.
Where
cash.
is the designated fund total?
Paul, mind your manners.
I am, and you could mind your manners too. I have a specific question and no one is answering it, and I'm trying to get an answer. I'm sorry if that offends you.
Who would be the appropriate person to answer that question? Is
The
that
treasurer, he's the one that provides the financial statements.
It shows on the balance.
Sorry, Chris, didn't mean to drop you in the grease.
Chris or Eldon? Or anyone on the finance committee? Do we know
Yeah.
where?
Well, Paul is correct. In the past, if you had an amount of cash that was designated for a particular purpose, it would have appeared as a dollar in the cash asset inventory, and it would appear as a liability on the other side of the balance sheet on the financials. And we traditionally showed those as liabilities. So they appeared as if they were debts of the congregation. So we had the cash, but we owed the money. And in some cases, we owed it to ourselves. And in some cases, we owed it to a potential project. These could have been things like money that was raised for the youth trip to Germany. And so it would sit there as cash, and there would be a liability showing on the books saying, one day you're going to pay this. It could also be we raised money at the annual festival, and it was money that was going to go to CCSC, something like that. So we had a cash on the books. We had a liability to CCSC that needed to be paid. Once it was paid, the liability went away and the cash went down. Okay. Andrea was brought in to help us, I'll use the word modernize our books to make them more in line with what other places are doing. She made the observation that many of these, if not all of them, are not true liabilities in a sense that they are owed to yourself. They might be inappropriate to show them as liabilities, quote unquote. And my understanding is that she has begun presenting those as sub-accounts within the equity area.
That's
I
right.
haven't seen, yeah. So Eldon can point you to the right account line and so on, but they show up in equity as a fund balance, right? So the liability entry is to equity, the cash entry is to the asset side is to the cash, and then Ron and company are going through a process to have an inventory of all those liabilities in detail down to the individual recipients of those designated funds and who's responsible for the decisions on spending or not spending each one of those types of accounts. That's a part of this project that's being put together now. So, for example, I mentioned the youth trip to Germany. Okay. If you choose to donate to that trip, there is a process whereby that cash goes into our bank accounts. Cheryl and Andrea appropriately register it into the youth travel fund account as an equity account. And Ron's balances would show that. And the total of all those would show on the balance sheet. And that particular fund, let's call that the youth travel fund, would have a designated person who can request and authorize spending out of that account. And that, in the case of the travel fund, that would be Ben Remmert, for example, right? So each of these different funds has a different person, or there could be the same person for several of them, but there's people who are going to be assigned to each of these. Whereas in the past, it's been a little in doubt as to who actually authorizes these funds to be spent. And that's been in a sense, part of the problem, because short of an individual person who's responsible, I have just defaulted to say, unless the congregation council approves it, that money's not to be spent. And so that's got us into a little bit of a problem, because they don't necessarily need to be approving every single $2 spend and so on. So we're trying to modernize that system. But Ron, but you know, Paul should be able to, and anybody should be able to go into that equity section of our balance sheet, and Eldon can make a presentation of this separately, but we should be able to see not only a combination of all the designated funds in total, but there's detail behind it there's about 30 or 40 different funds that add up to that total. And each one of them has a tracking and goes through the tank.
Or in a line item that were designated assets.
Ask that again, please.
They're just cash.
Could those be listed as designated assets if they meet those qualifications? That, you know, we know they're coming out.
I think we need
Only
to take
tax
this- I think we need to take this offline and address
Yeah,
it with the
okay.
committee.
And
I think we understand the issue and the concern, and we want to make this very clear of what these designated funds are, who uses them,
Yeah.
and what our responsibility is. And so it's.
We'll have it updated our October forum.
Yeah, I don't, I'm not being critical, I'm just saying,
Yeah.
it seems like a device.
They're good questions, but they're very specific and have a specific answer, and someone can figure it out and share it later.
Yeah.
Do you want to have any questions?
That's right.
about-
I would like to make the point that for the entire period that I've been involved with this, which is at this point maybe 7, almost 8 years, 8 or 9 years actually, the balances in those funds year to year tracking along. If you go back through the financial statements, you do see those balances moving. And there's a history of payments and donations going into certain accounts, money coming out of certain accounts. I don't believe we've had a lot of problem in that area once the Noel theft issue was resolved, was determined, right? I don't believe that there's been a problem with misallocating or not being able to locate funds going in or out of those monies going in or out of those funds. The problem that Ron's really trying to solve is that some of the funds have designations on them that don't matter anymore. So for example, if there's a designation that says this money is for is to mow the grass in the front lawn, but now we have AstroTurf, just as an example, right? There's no need for that. And so what do we do with it, right? Another example would be there's a designated fund that has a fairly decent balance in it that relates to the niches outside, right? And that money was raised with the specific intent of handling the columbarium and associated costs. So what is that? Does that mean the lawn and lawn care inside the wall? Does it mean the door to the columbarium, on the building? And over the years, we've spent money for those things, but not necessarily taken it from those funds. Maybe inappropriately. Maybe we should have taken it from those funds.
Yeah.
And so that's a part of the analysis that's being done, is to go back and sort of right size all of these accounts and understand what they're for and what their balances are currently, and explain all of that, full disclosure to everyone who wants to understand it.
Any other?
I have a closing comment for Eldon. Hey, Eldon, we got to 31 people.
All right.
Somebody just walked in.
All right.
Does that
any
include
other-
online?
I think we have 5 online.
34.
7 online. Great.
7. Oh, 38. You're
All right.
kicking it, man. You are awesome, Eldon.
So thank you to all of our finance people who volunteer a huge amount of their time. Thank you, Chris and Eldon, for your presentation and your continued work. And we will see everyone back in October for our next update. I really do encourage you to send emails, questions, texts, however you want to get in touch with us to ask the finance team questions. All of the questions on all of these forums will help us reduce our time at the annual meeting so that everybody has a really good understanding going into that and should streamline that process. So Thank you all.
Thank you.
Thank you,
Thanks,
guys.
everybody. Cheers.